The screen says $73.72. The banks say $73.72. Bloomberg says $73.72. But when you woke up this morning, silver was at $78.31. They want you to believe it was just another bounce. They want you to believe the rally is still broken. They want you to believe the crash on Monday was real. They are lying. And this isn't just a small lie. This is one of the most textbook bear traps the silver market has seen in years. While you were staring at the $73 low on Monday, while you were panicking about the 11% crash, while you were reading headlines about silver's historic rally coming to an end, something happened between Monday, December 29th and Tuesday, December 30th that nobody is talking about. The shorts got annihilated, the weak hands sold at the bottom, and the smart money loaded the boat. There is one missing detail in every article about Monday's crash. There is one missing detail in every analyst report about the margin hike. There is one missing detail that explains why silver rocketed $3.08, 4%, in less than 24 hours. The missing detail? It was a bear trap. And if you don't understand what just happened, if you don't understand why it happened, if you don't understand what comes next, you're going to get left behind when silver breaks $80, $90, and eventually $100. Over the next 40 minutes, I'm going to show you exactly what happened. I'm going to show you the verified data from US Gold, Trading Economics, and Yahoo Finance. I'm going to show you the CME margin hike that triggered the trap. And I'm going to show you exactly how to position yourself for the next leg up. Because this bear trap, it's just the beginning. Let's go. Let's start with what actually happened on Monday, December 29th, 2025. Silver opened the day at $83.71 per ounce. By the end of the session, it had crashed to a low of $73.72. That's a drop of nearly $10. That's an 11.9% crash in one day. Here's the official data from Yahoo Finance. Monday, December 29th, 2025. High, $83.71. Low, $73.72. Drop, $9.99. 11.9%. Every financial outlet ran the same story. Silver's historic rally comes to an end. Precious metals crash after margin hike. Is the silver bubble bursting? The narrative was everywhere. Retail investors panicked. Weak hands sold. The forums were filled with fear. I sold at $74. I'm out. This rally is over. CME killed the momentum. But here's what nobody told you. Here's the one thing the headlines left out. The crash was triggered by a CME margin hike. On December 29th, the CME Group, the Chicago Mercantile Exchange, raised the margin requirements for silver futures by 50% overnight, without warning. Here's the official notice from CME Group. Effective December 29th, 2025, initial margin for silver futures increased from $12,000 to $18,000 per contract. Do you see what happened? This wasn't organic selling. This wasn't a fundamental shift. This was a forced liquidation. Traders who were long silver futures on margin got hit with margin calls. They had two choices: post more cash to meet the new margin requirements or liquidate their positions. Most chose option 2. They sold. And when everyone sells at the same time, the price crashes. $73.72. That was the low, that was the trap. Now let me explain what a bear trap actually is, because this is critical. A bear trap is a false technical signal that tricks traders into thinking a downtrend has started. Here's the textbook definition from Investopedia. A bear trap is a false technical indication of a reversal from a down market to an up market that can lure unsuspecting investors. In plain English, the market crashes. Everyone thinks the rally is over, they sell, then the market reverses hard, and the sellers get trapped. That's exactly what happened on December 29th and 30th. Let me walk you through the mechanics. Step 1, the trigger. CME raises margins by 50%, forced liquidations begin, price crashes from $83 to $73, weak hands panic. Step 2, the capitulation. Retail investors sell at the bottom. Forums fill with fear, headlines scream rally over, the trap is set. Step 3, the reversal. Smart money steps in. Physical buyers start loading. Short sellers begin covering. Price rockets. Step 4, the snapback. Tuesday, December 30th, 2025. Silver opens at $73.72. By the end of the session, it hits $78.31. That's a gain of $4.59. That's a 6.2% intraday recovery. Here's the verified data from US Gold. Tuesday, December 30th, 2025. Price, $75.69. Change, plus $3.08. Percentage, plus 4.07%. And here's the data from Trading Economics. December 30th, 2025. Price, $76.34 per troy ounce. 24-hour change, plus 5.81%. Do you see it? Plus $3.08, plus 4%. In less than 24 hours, the shorts who sold at $73, trapped. The weak hands who panicked, left behind. The smart money who bought the dip, winning. This is textbook bear trap behavior, and it's backed by verified data from multiple sources. Now let's talk about why this bear trap is so significant. Because this isn't just about a $3 bounce. This is about what comes next. Let me show you the numbers. When silver crashed from $83 to $73, a lot of traders opened short positions. They thought the rally was over. They bet on further downside. They were wrong. When silver reversed and rocketed back to $78, those shorts were underwater. Here's the math. Short entry, $74 average. Current price, $78.31. Loss per ounce, $4.31. Now multiply that by the size of the short positions in the silver futures market. Millions of ounces. Those shorts are now forced to cover. And when they cover, they have to buy, which pushes the price higher, which forces more shorts to cover. This is a short squeeze, and it's just getting started. Here's the other side of the equation, physical silver demand. While the paper market was crashing on Monday, physical buyers were stepping in. Dealers reported a surge in orders at $74 and $75. Mints saw inventory drain. Premiums started rising. Why? Because physical buyers know the fundamentals haven't changed. Industrial demand, still growing. Solar, EVs, electronics, still consuming silver. Supply deficit, 5 years in a row. Central bank diversification, still ongoing. The paper price crashed, but the physical market didn't flinch. That created a floor at $73, and that floor is rock solid. Now let's look at the technical setup. Before the crash, silver was trading in a range, support at $78, resistance at $84. The Monday crash broke support. Everyone thought the range was dead, but then Tuesday happened. Silver reclaimed $78, it's back inside the range, and now the $73 low is acting as a bear trap bottom. Here's what that means technically. The trap flushed out weak hands. The reversal confirmed strong support at $73. The reclaim of $78 signals bullish continuation. Next target, $84. If silver breaks above $84, the prior high, it's game over for the shorts. The next leg targets, $90, round number resistance. $100, psychological level. $105 plus, breakout continuation. And with the bear trap now confirmed, the path of least resistance is up. All right, you understand what happened. You understand why it happened. Now let's talk about what you do with this information. Because if you play this right, the bear trap setup gives you a massive edge. Here's your strategy. Rule 1, buy physical silver on dips. This is non-negotiable. If you don't own physical silver yet, every dip is a gift. The $73 low on Monday was a screaming buy. If we get another shakeout in the $75 to $78 range, you buy. Why? Because the bear trap confirmed that $73 is the floor. Any price near that level is value. Where to buy? APMEX, JM Bullion, SD Bullion. Buy coins, buy bars, buy physical. Do not rely on ETFs like SLV. Do not trade paper silver if you're a long-term holder. Physical only. Rule 2. Avoid panic selling. Monday, December 29th was a test. Weak hands sold at $73. They failed the test. If you're holding physical silver, you do not sell on crashes, especially crashes triggered by margin hikes or technical shakeouts. You hold, you ignore the noise, you trust the fundamentals. Because 24 hours after the crash, silver was back at $78. The weak hands lost, the strong hands won. Don't be weak. Rule 3. Watch the $84 breakout level. $84 is the key level to watch now. That was the high on Monday before the crash. If silver breaks above $84 and holds, the next leg is confirmed. Targets. $90, first resistance. $100, psychological magnet. $105 plus, measured move from bear trap. Set alerts at $84. If we break it, add to your position. Rule 4, monitor premiums and inventory. The real signal of a supply squeeze isn't the spot price, it's the premium. If premiums start spiking, $5, $6, $8 over spot, that's your confirmation that physical is getting tight. Also, watch dealer inventory. APMEX, JM Bullion stock levels. Mint allocation programs. US Mint, Royal Canadian Mint. Delivery delays. If dealers start pushing ship dates, supply is breaking. These are leading indicators. Rule 5, use dollar cost averaging. If you're just starting or adding to your stack, don't try to time the bottom. Use dollar cost averaging. Set a fixed amount per month. $500, $1,000, $2,000. Buy on a schedule. First of the month. Ignore daily price swings. Over time, you'll average into a strong position. And when silver hits $100, you won't care if you bought some at $76 and some at $79. You'll just be glad you stacked. Rule 6. Set exit targets if you're trading. If you're trading silver, not stacking for long term, set profit targets now. Example, exit plan. 25% of position, sell at $90. 25% of position, sell at $100. 25% of position, sell at $110. 25% of position, hold for mania peak, $120 plus. This way, you lock in profits along the way, but still participate in the big move. Never sell everything at once. Never hold everything forever. Scale in, scale out. Rule 7, ignore the noise. The media will keep running bearish headlines. Analysts will keep calling tops. Trolls will keep saying silver is dead. Ignore them. Trust the data. Verified recovery, plus $3.08. Verified bear trap, $73 to $78. Verified margin trigger, CME hike. Verified support, $73 floor held. The facts are on your side. The trap is confirmed. The next leg is loading. Don't let noise shake you out. So here's where we are. Monday, December 29th. Silver crashes from $83 to $73. Headlines scream rally over. Weak hands panic. Shorts pile in. Bear trap set. Tuesday, December 30th. Silver rockets from $73 to $78, plus $3.08, plus 4% in 24 hours. Shorts trapped. Weak hands left behind. Smart money winning. Verified sources. U.S. gold, plus $3.08, 4.07%. Trading economics, plus 5.81%, 24 hours. Yahoo Finance, $73.72 to $78.31. CME Group, margin hike confirmed. This isn't speculation, this is data. And the data says the bear trap is confirmed. The next targets, $84, breakout confirmation, $90 first resistance, $100 psychological magnet, $105 plus measured move. Your move, buy physical on dips, hold through volatility, watch the $84 breakout, monitor premiums and inventory, ignore the noise. Because the bear trap just exposed the weakness of the shorts. And when they cover, silver is going to fly. Are you ready? If you found this analysis valuable, hit subscribe, drop a comment, share this with someone who needs to see it. I'll see you in the next one.